Hello and welcome to Credit Versio's Q&A Live Wednesday for June 8th. I'm your host, David Michalek. I'm a consumer credit expert with nearly 10 years of experience. I've conducted well over 10,000 one-on-one credit coaching consultations, and I'm really excited to share everything that I've learned with you here on our Facebook Lives. And we missed last week. My partner and I drove out to one of our other partners and had a great time meeting up with them. So we are back, and it's just us today. So we're able to expand the topic a little bit, talk a little credit repair if you like. Thank you so much for being here. And please introduce yourself. Say hello. It's been a while since we've been on together, so I definitely want to get some great questions today. And one of the very important things that we talk about when we get on the call, hey, Louis back, good to see you, welcome, is the importance of our credit report and scores. And as you know, or maybe don't know, they play an incredible role in so many areas of our life. Our insurance company, landlord, mortgage broker, banks, even our employers have the ability to look at our credit report to see how we honor our obligations. So having great credit is mandatory because credit reports are no longer just credit reports. They become our adult report cards. They grade us on how well, they tell the story of how well we do when we are entrusted with credit. So that's why we do these weekly live Q&A sessions. So welcome. I see Cliff is here. Good to see you. We got a pretty good group today, so please don't be shy. Introduce yourself. Let me know where you're watching from if you would. And while we're doing that, here's what we're going to do today. I'm going to start off telling you a little story. I don't know if you saw the headline of what I'm going to talk about today. Hey, Scott Oliver, good to see you. Welcome back. Hope you guys didn't miss me too much last week. So we were very productive last week. Unfortunately, I wasn't able to do the Facebook Live. My partner David, who sits across from me here, we did a 23-hour marathon. We were up at 3:30 or 3 o'clock in the morning, left Las Vegas about 4 in the morning to head off to Irvine, and it was just meetings all day long, and we finally got home at about 1 o'clock in the morning, I think. So that was a long day. But anyway, so happy to be back. And what I'm going to do today is I'm going to start off with a little bit of a story. And the story is, how I went from great credit to really, really bad credit. And with that great credit was a tremendous amount of financial prosperity, and how all of that disappeared. In fact, it kind of segues into how I got into the credit repair space. So this is great credit, financial prosperity to complete financial ruin and bad credit. So and there's a reason why I'm going to tell you this story, because it's going to tie in a lot to what's going on right now. Let's see. It's Best Friends Day. Where's my shot? Hey, Mike, good to see you. I read your comment before I looked at the name, so I should have known. All right, so let me tell you this story. And by the way, when I'm telling this story, feel free to interrupt. If you've got a question about something, that's what I'm here for. But I want to tell you this story because it's really going to tie into a lot of what's going on right now. And, they say there's nothing new under the sun, and if you live long enough, you're going to see a lot of things that cycle and that repeat. So this story takes place between the year 2003 and 2007, almost 2008. So at the time, I am really heavy into real estate. So I'm buying new homes. This is back when we had these crazy loans, no income, no asset, 105, 110% LTV, which means you could buy a home with no money out of pocket. You could even cover your escrow fees. I mean, it was crazy. It was a very crazy time. And what I spent my time doing is I would go to new home communities, because this is how much things were blowing up price-wise, and I would put up $5,000, $10,000 deposit on a brand new home in the earliest phase that I could get. Sometimes I would wait in line, and then what I would do is I would sit on that until they completed the construction. So anywhere from 6 months to 8 months, usually didn't take much longer than that. And then I had this house that I paid, as an example, I remember my first one that I did, I bought for $230, and I ended up selling that for, I think, $230. I think I sold it for $330 or $340. I made $100,000 off of it. So I was doing this over and over and over. At one point, I had 3 or 4 homes all being delivered at the same time. And what would happen is that the strategy, and this was very common actually, where I was where I was from. It was big here in Las Vegas, but I wasn't in Las Vegas at the time. I was in Southern California in the Inland Empire or Riverside County. This was, along with Las Vegas and Miami, the three biggest areas in the U.S. that were blowing up back during this great real estate boom that we had in the early 2000s. So anyway, here I am, outlaying a lot of cash buying homes, and from the time they went from dirt, where I left my deposit, to the time that they were built, I would have $75,000, $80,000 in equity. And what I would do at that point, yeah, exactly, Mike. No documentation loan is what I had. 2 mortgages, yeah. Lesson learned, yeah. So, Micah, this is going to be a story probably pretty close to home for you, and really a lot of people who are over 40 years old. I think I have a hard time thinking that there's probably not a lot of people in their late 30s that went through this. So, anyway, what I was doing with all of that money that I was making from the spread, the equity difference from the time that I bought the house when it was just a dirt lot to the time that it was delivered, and that $100,000 is, I would usually pay the short-term capital gains on it, and I would roll that into a 4-unit complex, a 4 or 5-unit complex. I kept them small enough so I didn't have to have an on-site manager. But I kept buying these over and over to a point where I think I probably had about 7 or 8, partnered with a couple of people on some of them. And even though these were commercial loans, these were residential loans, but for rent, they were very, very easy to get. So at that time, I was really highly leveraged. So I had a lot of money out with the rental units. I was fixing things, taking care of things. It all went on the credit card. I had tens of thousands of dollars in credit card debt. On my personal home, I had an adjustable rate mortgage. Okay, because that's what we did back then. And even though prices were crazy, loans were stupid, we had adjustable rate mortgages, we had balloon payments. And Mike, I don't know, let me ask you this. Do you remember the neg-am loan? Any of you remember the negative amortization loan? That's a hard one for me to say. So it's referred to as a neg-am loan, which means that your payment was probably maybe here, but what you owed was a little bit higher. So your payment was lower than what it would take to satisfy the debt. So negative amortization, meaning a balance that was left over every month because you weren't paying enough, would roll into the principal. One of the dumbest things of all time. Now, I never did any of that, but that's how crazy that time was. So it didn't make sense. And a lot of us who were, towards the end there, towards about 2005 and 6 is when I think I bought my last 4-unit. And all of us were just like, oh man, this is going to be maybe possibly bad, because now we're starting to have a hard time selling our property. It's getting tight. People are coming in at not quite there weren't offers on top of offers on top of offers like it was. And I remember, I don't know if it was Newsweek or if it was Time, but I remember on the cover of one of these magazines, it was talking about how how the real estate market's going to have a nice soft landing. And that's what people believed. But despite that, I remember at the time, and a lot of us who were investors at the time, feeling sort of uneasy. Like, this is not sustainable. You can't do this long. By the way, this is going to come to a point here in just a second, but I want you to kind of hang with me as I'm explaining this to you. So I remember that nobody really wanted to look at it too closely, because, we're all making a ton of money. We're all, and all the property that I bought, by the way, those 4 units and 5 units, those were all bought on speculation. What that means is that it wasn't necessarily cash flowing, meaning I was negative every single month because I paid this much for the property, and it was hard for it to cash flow. I was just breaking even, maybe a little bit backwards. But I bought it thinking, okay, in a year from now, it'll go up another $50,000 or $100,000, and I'll sell all of them and make a bunch of money and roll it into something else. So that was the thought process. And then we all know what happened. Then the real estate market crashed. And that ushered in, and that had largely to do with the fact that those adjustable rate mortgages adjusted. And I remember that one. I remember my payment was this, and then it went to that in a very short period of time. And then, fortunately for me, and this is not because I had like some insight or that I saw this crash coming. It's just the way that things unfolded. I was able to unload my 4 and 5 units, even though I didn't make. Sometimes I sold one of them for exactly what I paid for it. So I was so highly leveraged. I had so much credit card debt because my thought was, well, I'm going to give it like another 6 months or a year. I'm going to sell these things. I'll make 100K on each of them. I think one of them I did. And then I'm going to pay off all of my debt and take care of everything. Well, that didn't happen. So the great crash took place. The great recession was on its way, and it wiped people out. Now, here's the interesting thing, and I'll explain why I'm talking about this. I was wiped out, even though I was successful at getting rid of all of my rental property. The problem is I had this much equity at one point, and then as the market began crashing, and I was selling these things, I was unloading these things, it came down to about like this, which means I didn't make anything. In fact, I went backwards on a couple. So when everything just began to crash, here I am getting rid of my property, except for my single family home, my private residence that I lived in, that I owned. And I was left with no equity, no profit, having to come out of pocket on a couple of occasions. And I had this massive credit card debt, incredible credit card, tens and tens of thousands of dollars. In addition to that, I had a mortgage that had just adjusted, and it wasn't an inexpensive place. I overdid it with how much house that I bought because it was a foolish thing to do. That's what people were doing back then, and unfortunately, I got caught up into a lot of that. So now I've got this massive mortgage, a big HOA, which that didn't change, obviously. That was always big. And then a tremendous amount of credit card debt, and my income was gone because everything had just pivoted. The market was gone. So why am I telling you this story? Okay, this was what, 15 years ago, where real estate went through its boom. And one of the things that I walked away with is this sense that when things just smell a certain way, and by that I mean when you can look at what's going on with the market, you can look at what's going on with credit, and you can tell something is up. Okay, that is what's going on right here. So I'm gonna share a couple things with you. And by the way, if you've got some questions, feel free to ask them. That's what I'm here for. Yeah, Mike, my loan was sold numerous times. Very hard to find out who owned my loan. You want to hear something funny, Mike? So I just closed escrow on a condo about 3 weeks ago. Now, let me explain this real quick. Normally, I would never buy in this kind of a market. But the reason why I did was for a couple of reasons. One, the interest rate was low. Two, this is a long play for me. So I'm not buying this house to sell it in 2 or 3 years because I'm going to move on to something else. This is like a forever home. I'm going to keep this for 10, 20 years. It's exactly what I wanted. It's a community that I lived in before. So it's okay to me knowing that real estate will probably adjust 20 to 40%. That's not my thought. That's what a lot of people who are in the know, who are following this, are speculating. That's okay for me. Okay, if I'm going to hold this for 10 years and it dips down, it'll come back up eventually. My big motivation was just getting into a place, my girlfriend and I, because we got kicked out of 2 places, and by kicked out I mean the place we were renting, the landlord wanted to sell it, and I don't blame them. It's a big market. They could make a lot of money, and they didn't want to renew the lease. I get it. It was very hard to find a place that would take our 2 pets. So I'm like, let's just buy. Let's suck it up. So, Mike, anyway, getting back to what I was about to say, the last time I bought a house was back in 2005. Personal residence, that is, not real estate in general, but a personal residence. And you're right. Same thing happened to me. It got sold to WAMU, then got sold to Countrywide, then got sold to somewhere else. And I think Bank of America ended up with it, and then Aquin ended up with the second mortgage. So, yeah, it changed hands over and over. And the funny thing was, just this weekend, I was setting up on my auto bill pay the mortgage payment. I'm like, okay, now I'm going through all the title paperwork. I know who my lender is. I'm like, and I just had that thought, probably like you. I think you know where I'm going with this. I'm thinking, okay, if I set this up, is it going to be sold again? How many people are going to buy this loan? Because that was my frame of reference from way back in the day. Is like it just changes hands over and over and over again. But I'm looking at it, and I'm thinking that the servicer is probably going to stay the same servicer for a while. I mean, who knows? Maybe they'll sell it, but it's a big bank. Okay, so anyway, Let's say I owed 167 to the bank. The bank would not help me with bringing down my payment, so I had to let it go. Sold the house for 93K. Yeah, what a joke. Okay, so yeah, so my home, I won't even tell you what I paid for it or what it sold for, but the disparity was phenomenal. I mean, it sold for about 30%. Wait, yeah, it sold for about 35, almost 40% of what I paid for it in 2010. So 2 years. That's from the time that, well, from the time that the Great Recession started, 2008, to the time that I eventually just had to let it go. I couldn't, I couldn't keep it, unfortunately. Okay, so let's get back to why I'm talking about this. And I'm glad that the number of watchers is staying the same. I'm glad you're all still here. I appreciate that. Here's why. I'm going to share something with you. So this is from Bloomberg, and this is today. So let me share my screen real quick. I'm not going to read the whole article. I just want to touch on some bullet points. Okay, so I hope you can see this, or just look at my cursor. This is where I'm going. So Bloomberg, U.S. consumer borrowing surged again in April, following a record jump a month earlier, fueled by rising prices and continued strength of American consumers. So I think this American strength of American consumers is a little bit of a facade, and we'll see why in a second. Okay, let's go down here. Revolving credit outstanding. So we're talking about credit cards. It says which includes credit cards, but essentially revolving credit is credit cards. Increased 17.8 billion after surging 25.6 billion in the month before. Okay, we don't need to cover non-revolving. Let's go down here a little bit. Americans have so far continued spending in the face of surging prices, including in April, when personal outlay rose about 1% or 0.1%. Okay, so excuse me, 1%. Okay, let's go down here. With inflation largely outpacing wage growth, consumers have leaned on both savings and credit cards to pay for everyday essentials and discretionary purchases, aka discretionary, aka non-essential. The savings rate is at the lowest level since 2008. All right. So what's going on? What did I learn in 2008? What wiped me out in 2008, 2009, 2010? What wiped me out was I was over leveraged. What wiped me out was credit card debt. So I wasn't paying attention to that stuff like I was now. So what's happening right now? What's happening right now is you can't get less than 75% of the CEOs, the big CEOs in the United States, to say that they don't think we're going into a recession. Now, let me qualify this. I'm not a financial planner, I'm not a financial expert, I'm not an economist. I'm just conveying what is out there for consumption in the public. Okay, it's easy to confirm what I'm telling you. So, and again, it's not to scare, it's to prepare. So what did I learn in 2008 about credit card debt? I actually would have survived okay having unloaded all of my property when I did. And again, it's not something I did because I really knew what was going on with the market. It's just the way that things unfolded for me. I did end up losing my home to foreclosure. What I couldn't recover from was the tens of almost $100,000, actually it might even been a little bit more than that, of credit card debt that I had from all of the property that I had bought because I was doing improvements. There's a lot of compliance things you have to do. A lot of my property was Section 8. And my thought process was, well, I'm going to hold it. I'll sell it in a year or two, and then I'll make minimum payments. I'll get by. And then once I sell these properties and make the money that I was anticipating I would make, because the market was doing great, it was always going up. We all thought, hey, it's never going to end, or it's going to wind down slowly, which obviously it did not. And I would sell these properties to take some of the equity and satisfy all the credit card debt. Okay, that didn't happen. So being over leveraged was a killer. That's what wiped me out. That's what wiped a lot of people out. Okay, so what am I doing this time? That's different. Okay, first of all, I'm paying attention. Okay, I'm watching, I'm reading Bloomberg, I'm watching everything that's going on. I read Credit and Collection News. That is telling me everything that's going on in the credit space. And I'm watching this pattern take place. Inflation is up. People are not adjusting their spending based on what's going on with inflation, meaning like, hey, things are getting more expensive. A lot of this is very unsustainable. We've been printing money for a long time. We had stimulus checks. So all this stuff is going to, there's going to be a price to pay for it. And what I'm doing now is I'm checking my discretionary spending. I'm not keeping any credit card balances at all. In fact, uh, Mike, this I think you'll find this relatively entertaining. But I mean, we moved in. We've been moved in for about 2, 3 weeks now. We have we have all of our paintings and artwork and stuff on the floor, not on the walls where they should be, because we're going to paint at some point. But I'm making sure that I put plenty aside. I've recovered, recovering from the down payment. And yeah, I could throw it on the credit card, not a problem. But I'm not carrying credit card debt right now. That is the number one thing that I'm recommending that people do. Yes, I get it. It's easier said than done. But you don't want to have big credit card debt right now, because when things pivot, now it might take 6 months for us to officially enter a recession. We'll know actually January 1st. A recession is defined as 2 quarters back to back with when GDP drops. First quarter, GDP dropped 1.5%. July, we'll find out if GDP dropped again a second time. That means officially we're in a recession. Now, it might those are just words. Well, when are we going to really start to feel that? 6 months, maybe 24 months. Depends on how much involvement our politicians want to get in to try to forestall this. But they can only do that to a degree. Okay. All right. So the two things I'm doing. One is I'm watching my discretionary spending. Okay. I'm paying off credit cards, and I'm also paying down. I only have one installment loan apart from my mortgage, which is my car. And I'm paying that down faster, because when things turn, and again, I hope that they don't, but we do see these cycles it used to be every 5 years. Now it's been 10 plus. I don't want to be in the same position I was before, holding a ton of debt when things get a little bit more challenging. Okay. Mike, yes, I'm having to readjust my budget without adding credit card debt. Yeah, absolutely. I mean, this is when I read articles like this in Bloomberg, when I'm watching what's going on, it's so much of human nature for us to forget. And it wasn't really all that long ago. I mean, the Great Recession was really sort of started in 2000, and I remember feeling it in 6 and 7, because things began getting a little bit difficult to sell. Things started to not make a lot of sense. They weren't penciling out anymore. And then 08 came, and then we suffered that for virtually a decade, really. So what's happening now, I'm in Vegas, which is one of the fastest growing real estate places in the country. Prices are crazy. They're actually starting to taper a little bit, which is actually pretty good news. It's also an indication that this run is coming to an end. So, yeah, Mike, glad to see that you are adjusting your budget. I hope that we all are. I hope that we're all looking at this and keeping in mind that when things turn around, or when things turn and we have a recession. Again, I'm not an economist. I'm not a financial planner. I just see a lot of the same things. It's different than it was in 2008. I mean, it was all real estate crazy, loan driven back then. But now today, crazy driven by stimulus and printing our way out of problems, lockdowns, everything else that you just can't recover from with more stimulus. So I'm holding on to cash, not putting anything on cards, trying to pay off debt like installment loan a little bit faster while not dipping into the savings. Okay, thoughts on that? Let me get your input. If you have any comments, questions, disagree, agree, let me know. Then we'll move on to the next subject. But that's something I wanted to share with you because, as I was saying a second ago, it's really, really easy to forget that we really have to be mindful of our credit card spending. And it's easy to forget that we just had a big crush to the economy back in 2008, 2009, 2010. It took us a while to get out of it. All right, Joseph, the other thing too is then credit card companies can start cutting your credit limit and drive down your credit scores too, because credit utilization would increase if you have a balance. Joseph, great observation. You know, when we saw this take place, right when COVID started, right when the lockdown started, That was a really, really big thing. In fact, we got Credit Versio launched right when that started. We launched in March of 2020. So right about that time, that's when the lockdown started. And people were having really, really good success getting results with Credit Versio. Just like if they had hired a high-end credit repair company, the same thing was happening. Things were getting deleted, but we were seeing people's scores dropping. And we're like, oh, this is kind of an unusual. I mean, it's not too unusual because sometimes if you delete an account that's got a lot of history, you can drop your average age of accounts. But normally that's not the biggest deal in the world. It's about 15% of your score, or it's in the category that's 15% of your score. I'm not saying that you're going to lose 15% of your score if you get an old account deleted. So when we were looking at this and people were calling in, we're like, oh my gosh, your Chase card just took your credit limit from $5,000 to $500. They were closing accounts. They were limiting the line of credit because they're hedging their bets. Listen, they're banks. They got to make a profit. Okay, they understand what time it is. When people are being told to stay home, when they're getting laid off, they can't work. This is before anything stimulus was beginning to happen. Credit card companies are doing an assessment of all the accounts that they have out there, and if they're going, okay. And by the way, your credit card provider is doing this, so they will do what's called a soft pull. Okay, you'll never see it. It's not. It's something that we've all approved when we get a credit card, but they'll check up on us every now and then just to see what's going on. So if we start getting late payments, or if there's anything fishy going on in our credit report, that creditor might say, hey, you know what, I'm a little uncomfortable with the terms of our extension of credit via the credit card to this person, so we're going to reduce their line of credit. Happened a lot. A lot of cards that hadn't been used in 12 months, 18 months got closed. So I had a ton of people calling up like hey, my Discover card, I haven't used it in like 8 months, 12 months or so, and they closed it because it was $5,000, $10,000 of available credit that was sitting out there that Discover, among others, understands like, wow, if the stuff hits the fan, then this person, out of an act of desperation and need, is going to start charging things on our card, the Discover card, and pretty soon we're going to have somebody default on that debt. It's a very understandable position for a bank. But Joseph, yeah, you're 100% right. When this happens, the lending market tightens up, and banks don't want to lend. The banks only want to lend to people who don't need the money anyway. But when things get a little speculative about what's going on with the market, then that's when they're going to tighten things up. And sure, yeah, the byproduct of that is if you do carry credit card debt and they do reduce your lines of credit, then yeah, that's a big part of your score. You can see credit scores drop pretty considerably. So keep that in mind. All right, great. So, another thing also to keep in mind is making sure that we're doing things that protect us against anything that's derogatory. Like one of the first things that I did once the mortgage closed, I got all the paperwork. I love to put everything on auto pay. I can't tell you how many stories that all the consultations that I've done. In the beginning of this video, I say that I've done over 10,000 credit repair consultations. Well, if you include sales consultations, meaning talking to people over the phone, analyzing their credit reports, going through the review with them, what is their goal, what's on their credit, why is it there, why are we disputing this? I've done well over 20,000 of those. And I can't tell you how many times I've been on the phone with somebody with like, well, yeah, I got these late payments because I just forgot to pay it. I'm like, well, how did you forget? How do you forget to pay it? It's a car payment. It's the same payment every single month for, depending on the terms of your loan, anywhere from 36 months maybe. I don't see very many of those, but probably a 60 month or a 72 month. How'd you forget? It's like, well, I just didn't, something happened, I forgot about it. That's really common. Not so much so with auto loans, but it really happens a lot with credit cards. Like the majority of late payments that I have seen in my career that spans almost 10 years now is late payments on credit cards because they just forgot to pay it. And by the way, same thing happens with utilities. Utilities don't report to the credit bureaus, of course, until it goes into a collection status. And then in a lot of cases, it reports. And the story that I get with that is like, well, I feel I didn't owe the money, or I got overcharged, or I just forgot to pay it, or I didn't return my cable box. So it's things like this where you're really going to want to be sharp with everything that is going on with debts that you owe, with your credit utilization. Because I promise you, when things start to go south a little bit, that's the first thing that happens is people get a little discombobulated. They're like, oh, what do I owe from this credit card? What do I owe on that credit card? And just set up your minimum payments. Like I've got 5 credit cards. Every single one of them has a minimum payment feature. Meaning, and by the way, they didn't have this back in the day. I don't know if the Card Act is what prompted this kind of a change, but back in the day, like there was no reminder. There was nothing to remind you to at least make your minimum payment on your credit card. And the reason for that is credit card companies like those late fees. In fact, one of the quotes that I heard a while ago is that credit card companies like consumers who pay their bills mostly on time. So what I mean by that is they're not going 60 days late, 90 days late. They're not doing anything like serious derogatory. A serious derogatory would be 90. A minor derogatory would be 30, 60. But a lot of credit card companies are like, if they're going to be maybe 2 weeks late, 35 days late, they'll get dinged for having a late payment, but they're not going to close their account because the interest rates go up typically, the fees go up. A late payment fee, I don't know what it is now, but I'm sure on some cards it could be $25, $35, $40, not entirely sure. But these are the things that you absolutely want to avoid. So nowadays, if you go into like my Discover app, my Chase, my Citi card, they all have settings that will go into my bank account and take out my minimum payment if I don't take any kind of action at all, which is a great thing. One of my good friends years ago, and forgive me if you've heard this story, I've told this story many times. Guy my age, so at the time he was probably in his mid 40s, so this is going back a little ways, and he had a minor heart attack, and he was in the hospital for I think about minor heart attack, but he was there for some other things too. He was in there for about 3 weeks or so, and during that time there was a lot of things that were due. He ran the business. I don't know how many accounts that had to be paid to run the business. It was a lot. And everything was set up on minimum payments. Had he not done that, I'm not sure exactly what the landscape of his credit would have turned into, but it probably wouldn't have been good. Okay, Cliff. Hey, Cliff, good to see you. Should I have my cable bill added to my credit report? It depends on what you're trying to do, Cliff. There are certainly other ways to achieve the same thing. Are you talking about like self-reporting, like Experian Boost, something like that? Listen, if you don't have any other kind of credit, that's a perfectly reasonable way to go. Just keep in mind that these are not accounts that are going to be they're not going to have any effect on older FICO models. So this kind of stuff is beneficial if you have like the more contemporary models, FICO model 8, 9, 10, 10T. And 10 and 10T, even 9 are not used that much. It's the specialized industry-specific FICO models where having rent reporting or utilities reporting really doesn't do anything because the algorithm does not consider those. So if you're going to buy a home, buy a car, probably not going to have any effect on you whatsoever. Okay, but things like Self, I love Self. I think Self is a great route to go. Experian Boost is a great route to go. But you're really going to want to get things like I would advise you to get an authorized user if you can. I'm not saying buy trade lines, but if you've got a family member or a friend who can add you as an authorized user, that is infinitely better than adding your cable bill. Okay, let's see. Hey, David, have to leave early. Great conversation, Mike. So thank you so much for being here. I appreciate it. Mike, just received an Amex Gold credit card, charge card. How would it affect my credit score with no set spending limit to report? Yeah, Mike, that's a fantastic question. So American Express is one of those cards, some of them anyway, that don't have a credit limit. Okay, so how do they factor credit utilization. It's pretty easy, actually. So what's going to happen, Mike, if you do leave a balance on that card or whatever your highest charge limit was, they're going to report that to the bureaus, their next report cycle. And at the top of your credit report, it'll say high balance. It's usually towards the top of the account. So let's say you spend, you charge $4,000 for something, okay? So what'll happen is, let's say you pay that off the next month. Well, American Express is going to report to the bureaus that your high balance or highest balance was $4,000, not your current balance, not balance owed. That's a different line altogether. So what happens is, in the future, that high balance, that $4,000, becomes the number by which your utilization is factored. So that's how it's done with American Express cards. Let me know if that makes sense. If it doesn't, I'll expand on that a little bit more for you. All right, let's see. What do I need to help remove old auto information? Yelly, create an account with Credit Versio if you haven't done so already. So what Credit Versio does, it reads your credit report, analyzes it. Anything that gets deleted from a credit report, this is a very important thing to understand. I've been saying this for years and years and years. Things get deleted from credit reports for only a couple of reasons. Well, 4 reasons, according to the Fair Credit Reporting Act. They're outdated, incomplete, unverifiable, or erroneous. Erroneous just means wrong. It's just not supposed to be there. Now, is there anything about your account that fits that description? Maybe there's an error on there. That's what Credit Versio does. That's why we have big credit repair companies that are talking to us about replacing their entire dispute processing teams with our software. We have a commercial version of Credit Versio called Dispute Desk, and this is for processing for credit repair companies. So what Credit Versio does better than human beings is it reads your credit report, and Yelly, what it's going to do is it's going to see if it can find something wrong with that. Let's just say it's an auto loan. I believe that's what you said it was. Yes, auto information. And if it doesn't see anything, it's going to know who that auto lender is. It's going to go into the database and pull out what is statistically the highest probability of a correction or a deletion for this particular kind of account with this particular lender, and it's going to offer you a suggested reason. It's the same thing that a high-end credit repair company would do. The difference is software is doing it as opposed to a human being looking at a credit report and trying to figure it out. And by the way, it's very, very, trust me, I've done this for years and years and years. It's very difficult to read credit reports and find errors between bureaus. It's a tremendous amount of data that you have to manage. And then when you get a second credit report, let's say it's 35 pages long, you got to compare it to last month's credit report, which is 35 pages long, and try to find the differences between the two. It's really, really hard to do. Okay. Cliff again, for the past 15 years, I've been paying cash for all of my expenses except for my mortgage. Great. And by the way, so Cliff, there's nothing wrong with using credit cards. And let me qualify this a little bit. I use credit cards to pay for just about everything. And the reason why is because this is a conscientious decision. Okay, I'm what is referred to as a transactor. I'm not a revolver. Okay, sometimes there are exceptions, like the recent purchase of a condo. A lot of stuff went on the credit card for various reasons. It was an expensive thing to do. But one opportunity, Cliff, that you might be missing is that as a transactor, if you're paying cash for everything anyway, what's great about doing it on a credit card is a couple things. One, you're using the bank's money and not yours. You pay it off anyway. You're going to get the points, the rewards, whatever comes with that particular card. So there's something to be said about that. Case in point, I use my primary go-to card that we use for the household is a Citi card. It's a Costco Citi card. And I just looked at my rewards, and I always pay that card off. I looked at my rewards for that card for the last, 4 months, 6 months. And I have over $500 of cash back, which I'm going to spend in Costco, no doubt. But hey, there's $500. Not only have I paid no interest on that card since I've gotten it, no annual fee, they're paying me about $500 to use that card because I haven't paid interest on that card. So Cliff, that's an opportunity that you might be losing right there. But again, it depends on what your comfort threshold is. If you like paying cash for everything, okay, great. I think it's a little bit safer to do with do a credit card, use a credit card because you're using the bank's money. There's a lot more protection that you have there than just paying cash, but that is up to you. Scott, Equifax finally decided to line up with the other two and raise my score 57 points yesterday. Finally, after years, I can see the light at the end of the tunnel. My experience that caused much of my bad credit was related to job losses. Yeah, that's a story that a lot of people have. The economy changes, people lose jobs. Illness is really the biggest one. A lot of the debt that is out there, collection debt anyway, is medical based. So yeah, but there's a lot of reasons why people go into a situation. But I'm really, really happy to hear that your score is moving up, Scott. Okay, Derek. Good evening. Credit Versio has been a big help. A few things were repaired, and I'm well on my way, almost achieving close to 700 score. Derek, that's awesome. I love hearing stories like that. That is very, very cool. You know, um, my credit repair journey was really about a total of 2 years. So I had a lot of stuff to remove. I was very fortunate. I think I had about 30-40% deleted. I can't remember exactly how much of it was removed, but it was a very, very proactive process on my part. So it took about a good 6 to 8 months just to get into the low 700s, and that was work. Like I was added as an authorized user. I was very lucky. I got a good handful of stuff deleted. A lot of other stuff aged off over time, of course. That's just a natural thing. And then it took another 2 years to get into the 800s. I had to really earn it. It's one of those things that I preach a lot is, okay, it's not really all that hard to recover from negative credit in a 6 to 12 month period of time, providing a lot of things go well. One of those things is making sure you're keeping your debt down. Don't overextend yourself with credit card debt. Okay, that's like the litmus test when it comes to your credit score. Is they are watching that, or when I say they, I'm talking about the algorithms that factor scores are really watching what you do with revolving credit. That's the easiest thing to screw up, and a lot of people stumble right there. So get into good habits, good money habits, making sure you pay these cards off if you can. I know it's easier said than done. Okay, I got a little bit of balance right now on my cards that I'm working down because of the recent home purchase. So life comes up, and you have to pivot in the best way possible for you. But try to get into the habit of paying those things off, paying them down to 10%, worst case scenario. Okay, let's see. Dakota, what if I want to set up Credit Versio account to help more than just your credit? I'm not sure. Well, Dakota, that's really what it's designed to do. It's an educational platform in addition to a platform to help you challenge accounts on your credit report while keeping everything organized and launching the most effective and legitimate and compliant dispute that you possibly can. If you have something else in mind, let me know. I'm more than happy to answer that for you. TD Haley, how is it that CB will say a credit verified an error or account, but when I call the creditor, they cannot find my name or account in their system? How are they verifying with the credit bureau, but they can't verify it with me? Okay, so that's a great question, TD. So what's happening is, let me just put that back up on the screen because that's kind of a big question. I want everybody to have an opportunity to read it. So what's happening when you file a dispute? This is a process that has very little human hands on it. So the first thing that happens is when you send it in a dispute, now whether it's paper or you do it online is handled a little bit differently. But for this example, let's just assume that it doesn't make any difference. So what happens is you have what's created is a online dispute or an ACD dispute. That's an automatic consumer debt verification, and that goes over to the bureaus. So it goes from the bureaus over to your creditors. So what happens is when somebody at that creditor opens up their eOscar account, they see that file. Okay, they see that dispute that came over digitally, and they're going to work that dispute. Now, sometimes data furnishers, creditors will just delete things based on the type of dispute that comes their way. There's a lot of things that they take in consideration. Sometimes you'll get an auto deletion, but if they're saying that it's been verified, that doesn't always mean that it was verified. It's actually pretty common, and there's a reason why in the credit repair space we have this saying that the dispute process really begins at round two. So TD, if you're responding to this is a question based off of your first round dispute, it would be very common for you to get that kind of a response. Now, this is just my belief. I don't really have any hard data to support this. This is just what I've seen from servicing thousands and thousands of clients hands-on over a period of coming up on a decade. But what happens a lot of times is when they get a dispute, when the bureau gets a dispute, sends it to the data furnisher, aka creditor, a lot of times they will come back and just say, hey, we did an investigation, everything is kosher. Well, they really didn't do an investigation, because I think what happens a lot of the times is people quit. So that's why you got to follow up with round 2 and round 3. Now, if they say that they have verified, like if you're on round 3 or 4 and it comes back, it's like, hey, we verified it. Well, then that's a conversation that's taking place between the data furnisher / creditor and the credit bureau. They have established that whatever is being reported correctly. All parties are satisfied. Okay. All right. Let's see. Just found you a few weeks ago and really enjoyed this information. Although I don't need your service, how can I support you and your content? Mike, I appreciate that. Hey, listen, there's a large percentage of the population out there that's got some credit challenges. If you know somebody, refer them over to Credit Versio. But at the very least, one thing that I really would love people to do is just go through the coaching course. You don't have to have a Credit Versio account to do that. You can go to our YouTube channel. If you're watching from YouTube, it looks like you're on Facebook, but put in Credit Versio on YouTube. We have a whole section here that's credit education. It's amazing the trouble that people can keep themselves out of if they just understand how some of these simple principles work in the credit space. Okay, well, that is coming up to what is that? Is that a wrap already? We are 50 minutes. Can you believe that time went that fast? And great group, great questions. Thank you so much for your interaction. If I didn't get I think I got to everybody's question, but if for some reason I didn't, I will swing back through. I go through all of these on Facebook anyway, on YouTube. Unfortunately, when the live ends, so do the comments. So if you didn't get a chance to ask your question, or if you didn't see me cover it in the video, I will get to it, I promise. Again, thank you so much for joining me today. I will be back next Wednesday, and we will cover whatever questions you have. I'll be joined by John Alzheimer with me. Gregory writes, wow, I missed the whole episode. Hey, Gregory, that's okay. You can watch the replay. Just scroll back to the very beginning, and you can watch this thing all the way through. Unfortunately, I won't be able to answer your questions live, but you can post your questions. I see that you're on Facebook. Just post a question in the comment area here, and I'll be able to answer it for you. I just always swing back within the next day or two and answer all the questions. Thank you so much for being here. I really appreciate it, and we will see you next time. Take care.